Money follows rules, not the ones printed in your constitution, not lessons taught in your classroom, but principles that have silently shaped power for 3 centuries. These rules determine who rises and who remains trapped, and most people don't even know they exist. Let me ask you something. Have you ever wondered why wealth always moves in one direction? The rich remain secure, the poor keep struggling, and middle-class families grind harder but slip behind. It's not chance, it's not conspiracy, it's structure. Unseen financial laws that have guided wealth since the 1700s. Before we dive in, take a second and comment below. Tell me where you're watching from and what time it is for you right now. I want to see how far these money laws stretch across borders, hours, and generations. Now let's begin with the first principle. It's called Gresham's Law. Simply put, it says that bad money forces good money out. 300 years ago, when coins held real gold and silver, rulers started mixing in cheaper metals to stretch their supply. People caught on. They began hoarding the pure coins and spent only the diluted ones. Over time, the real currency disappeared and the fake stayed in circulation. That same pattern still governs today. Only now, the metals are gone, replaced by credit, debt, and confidence. Think of it like this. When central banks flood the economy with cheap cash, low interest rates, easy borrowing, that bad money, inflated, borrowed, and unstable, replaces good money, savings, patience, and discipline. People stop saving and start gambling. They chase gains instead of security. And who wins? Those standing nearest the money printer, the banks, corporations, and funds that receive the first flow of new currency. By the time it trickles down through prices, loans, and wages, its worth has already been diluted. Gresham's Law isn't ancient theory. It's your paycheck losing value every single year. Now, the second rule. It comes from an 18th century economist named Richard Cantillon. His idea was simple, but devastating. Money is never neutral. When new currency enters a system, it doesn't touch everyone equally. It spreads unevenly, enriching some and draining others. This became known as the Cantillon Effect. Picture water spilling into a field. The ground nearest the source gets soaked first. Further out, it stays dry. In our era, that source is the financial system itself. When central banks print money or governments spend freely, the first recipients, investors, corporations, and asset owners can't get rich fast. Stock prices rise, property values soar, executive bonuses explode. But for workers and savers, costs climb long before wages do. You feel inflation before you ever feel the benefit. This isn't theory, it's evidence. After 2008, the Federal Reserve added trillions to its balance sheet. Stock markets tripled. The top 1%'s fortunes skyrocketed, but median incomes stayed flat. Homes became unaffordable. That's the Cantillon Effect unfolding in real time. A law written 300 years ago, alive in every stimulus, bailout, and bond buyback today. And here's where things get interesting. These old rules don't just explain the past, they forecast the future. Every time a government tries to fix the economy with cheap credit, it reinforces the same cycle. Bad money replaces good. Those nearest the source grow richer. Those furthest away foot the bill. You might call these laws unfair, and you'd be right. But they aren't evil. They're mechanical. Like gravity pulling everything downward, money follows predictable paths. Once you see those patterns, you stop fighting them and start positioning yourself around them. Pause for a moment. You've probably noticed something. Every crisis rewards the same crowd. Every recovery inflates the same assets. Every solution plants the next bubble. That's not malfunction. That's design A. System built centuries ago when early economists studied global trade and discovered that money behaves like energy. It flows toward where it's treated best. But there's one rule, even older than both Gresham's and Cantillon's, and it's the one that cements inequality. It's called Pareto's Principle, or the 80-20 rule. In any network, 80% of outcomes come from 20% of players. Applied to money, it means 20% of people hold 80% of resources. Left unchecked, that imbalance grows. 10%, 5%, even 1% dominating nearly everything. You can see it everywhere. In 1896, Italian economist Vilfredo Pareto noticed that 80% of Italy's land belonged to 20% of its citizens. Today, that same pattern runs through global wealth, corporate profits, and even attention. A tiny minority controls nearly all the results. The rule has endured for centuries because it's not about politics. It's about human nature. In markets, those who grasp money multiply it. Those who don't lose it slowly to inflation, taxation, and bad timing. The system doesn't honor hard work. It honors understanding, and most people never learn the rules. Let's connect the dots. Gresham's law explains why currencies corrode. Cantillon's law shows why new money lifts the top. First, Pareto's law reveals why inequality expands over time. Together, they create the unseen framework of modern finance, a machine so ancient and efficient that even revolutions, wars, and crashes haven't erased it. Yet here lies the paradox. The very same rules that widen the gap can help you rise above it. Once you understand how they move, you can act differently. You can hold assets that resist decay. You can position yourself closer to the money's source through ownership, investment, or enterprise, instead of being the last receiver in line. Before we move forward, consider this. Every financial shock you've witnessed, and from 2008 to 2020, is just a rerun of these old dynamics. Money expands. Quality declines, early receivers profit, late ones lose. The ratios shift, but the rhythm repeats. In the next section, we'll trace how these 300-year-old forces evolved into modern policy, and why even central banks can't escape them. Because once you grasp how the laws of money become laws of power, you'll see wealth through a completely different lens. By the 19th century, these financial laws were shaping nations themselves. Industrial revolutions, trade empires, and colonial systems all operated on the same silent mathematics. Those who controlled the supply of money controlled outcomes. Those who touched new money first built empires. Those who received it last paid the cost. Central banking turned these ancient mechanics into formal policy. Britain led the transformation. The Bank of England, founded in 1694, began issuing paper claims backed by gold. It loaned to the crown, earned interest, and expanded credit through lending. Gresham's law took effect immediately. Each time paper replaced metal, genuine value drained away. But the monarchy and its financiers gained leverage. They could finance wars and colonies without waiting for taxes to flow. That blueprint spread. France copied it, then the Netherlands, and eventually the United States. By the 20th century, the Cantillon Effect was no longer a byproduct, it was a strategy. Central banks learned to guide demand, fund governments, and inflate economies with controlled credit. Those closest to issuance, banks, corporations, investment funds, grew ever larger. Savers and wage earners absorbed the inflation that followed. This structure defines global finance today. Every bond auction, every rescue package, every round of quantitative easing, the same. Choreography repeats. The first receivers flourish, the rest adjust. Gresham's law plays out when excess credit drives out productive capital. Pareto's law concentrates wealth into fewer hands. You see both when housing becomes unreachable, when young people can't build equity, when markets soar without wages keeping pace. These aren't random outcomes. They're the results of rules that never stopped operating. To see how they converge, look to 1971. That year, the United States abandoned the gold standard. Money became pure credit. From that moment forward, dollars and debt became one. The supply of both began expanding together. Gresham's law foretold the result. When quality vanishes, quantity floods in. Inflation climbed, savings lost strength, investment turned speculative. The Cantillon Effect made the divide visible. Those near the source, banks, funds, and corporate giants, multiplied wealth through leverage. Ordinary people watched prices rise faster than paychecks. Pareto's ratio hardened. The top gained share. The base lost ground. You live inside that pattern right now. Every policy response since 1971 has followed the same formula. In 2008, credit froze. Central banks printed trillions. Assets rebounded. Workers waited years for raises. In 2020, stimulus checks landed after markets had already soared. By the time families spent them, inflation had erased the gain. Recognizing these patterns isn't pessimism, it's perspective. When you read about interest rates, deficits, or liquidity injections, you're watching centuries-old laws in motion. The names evolve. The arithmetic does not. So how do you use this understanding? Start by thinking like the early receivers. Money moves like a current, strongest, nearest the source. You need assets that float within that stream. Businesses, equities, productive property. Wages alone can't keep pace because they adjust after prices do. The system rewards ownership, not labor. That's why the wealth gap widens even in prosperous times. Every expansion channels new credit into financial assets first. The owners of those assets gain twice, first through appreciation, then through cheap borrowing. Workers inherit the leftovers, rising costs and growing debt. Let's walk through an example. Suppose the Federal Reserve slashes rates and begins purchasing assets corporations borrow cheaply to repurchase their own shares. Investors watch values climb. Executives collect record bonuses. Now, think about a family at home. Their savings yield less interest. Housing costs climb. To keep pace, they take on loans. That's the Cantillon Effect in motion. Not theory, but policy outcomes touching millions of lives. You can trace its footprint through data. Between 1989 and 2023, the top 1% share of U.S. wealth rose from 23% to more than 32%. The bottom half gained almost nothing. Each downturn sped up the divergence. The laws never faltered. Pareto's pattern plays out in markets too. A handful of corporations power most index growth. A few funds steer most capital. Small circle of investors drives trading volume. Across categories, concentration deepens because feedback favors scale. Once a group secures early access to capital, it compounds advantage through accelerating returns. These forces aren't confined to America. Look at Japan. Decades of ultra-low rates and asset buying enriched firms and patient holders. Look at Europe. Monetary unions shifted wealth toward core economies. Look at emerging markets. A strong dollar moves global capital against local interests. The rules function worldwide because they are mathematical, not national. Now imagine what happens when trust begins to fracture. Gresham's law warns that when people doubt value, they hoard quality. Today, quality means scarce assets, land, commodities, productive equity, sometimes digital stores of value. Every rush into alternatives mirrors what ancient traders did when coins were diluted. They retreated from weak money and clung to what couldn't be forged. For policymakers, that creates a trap. To sustain growth, they must expand, but each expansion dilutes quality, prompting flight to safety. To restore confidence, they must contract, but contraction slows growth. The cycle tightens until faith itself becomes the anchor. That's where modern finance stands, upheld by belief in principles written centuries ago. Your response to these laws shapes your outcome. If you depend solely on wages and savings, you're the last receiver. You feel inflation first and prosperity last. If you hold productive assets, you're nearer the source. You catch the flow. Early, that difference compounds across decades. It defines economic mobility. This understanding also clarifies political friction. When most citizens sense that prosperity lifts others first, they reject the system. As trust decays, populism rises. When policy favors asset owners, debt expands to placate the rest. Each cycle layers new credit atop old, reinforcing the structure. The outcome is predictable. Currency value erodes gradually. Debt ratios climb higher. Markets depend on continuous stimulus. Yet, the system persists because no participant can halt it. Each actor behaves rationally inside it. Governments borrow because voters demand. Banks lend because rates remain low. Investors chase yield because cash decays. Workers borrow because wages lag. Everyone acts logically. The structure still deteriorates. You're not powerless within it, but you must stop thinking in straight lines. These are not isolated events. They're functions. Once you recognize them as laws, you can plan within their boundaries. The final section explores what comes next. How these same 300-year-old rules may sculpt digital money, de-dollarization, and the next age of wealth. The world now runs on code, not coins, but the same monetary laws still determine outcomes. You can change the platform. You can't change the physics. Gresham's law, the Cantillon Effect, and Pareto's Principle still define how value travels, who gains first, and how wealth accumulates over time. Let's start with digital currency. Central banks are building CBDCs. They call it modernization. In reality, it extends control. When money becomes programmable, both issuance and access become targeted. Early receivers still get the first exposure. In emergencies, stimulus can flow directly, yet the logic endures. Those closest to creation stay ahead. Those furthest adapt later. Private tokens follow the same pattern. Each boom begins with insiders holding large allocations. As adoption spreads, newcomers pay higher prices. When liquidity expands, value shifts upward again. Gresham's law returns. When weak projects flood the space, strong ones disappear into cold storage. Bad tokens circulate. Good ones vanish from sight. Quality exits the market because confidence collapses. De-dollarization. Debates expose another principle at work. Nations holding dollar. Reserves know the cycle. The issuer benefits. First, each new dollar entering trade strengthens. U.S. access to credit and goods foreign holders inherit later claims. Over time, that imbalance pushes diversification. They seek gold, commodities, or rival currencies. The rule repeats. Bad money drives out good until trust resets. Inflation is no longer a domestic symptom. It's a global consequence of credit expansion. From 2000 to 2023, total world debt quadrupled. Every rescue, every deficit, every stimulus added to the tower. Debt became the collateral. Without it, markets cannot clear. Central banks now sit on trillions in government debt. That makes them both referee and participant. They stabilize markets by owning them outright. This is the clearest expression of the Cantillon Effect. The state creates debt. The central bank absorbs it. Commercial lenders treat it as collateral. Asset prices inflate. Wages lag behind. It appears modern. It's ancient. What happens next depends on how long confidence lasts. The system can't unwind leverage without crashing its collateral base. It can't expand forever without destroying its currency's power. The only route left is control. Extend maturities, suppress real yields, and manage perception. When trust falters, capital moves towards scarcity. Gold demand spikes. Dark real estate booms. Companies tied to real output outperform. Digital assets attract attention because supply is limited. Each reaction fits Gresham's law perfectly. People always trade away what decays for what endures. If you want to navigate the next era, study proximity. You can't halt credit creation, but you can move closer to its source. Own things that profit from early liquidity. Avoid speculation dressed as value. Diversify across different forms of money. Follow policy, not promises. History shows these transitions on repeat. In the 17th century, Spain's diluted silver shattered its empire. In the 18th, Britain's paper experiments financed its fleets. In the 20th, fiat currencies paid for wars and welfare. In the 21st, digital credit funds nearly everything. The surface evolves. The mechanism does not. You live inside a framework where value is assigned, not discovered. When new money enters, it reshapes every price. It favors debtors over savers, asset owners over earners. You can't wish it away. You can only place yourself within it wisely. Look 20 years ahead. If inflation averages 2%, half your savings will erode. If asset inflation outpaces wages, ownership gaps will widen. Pareto's ratio will persist. A minority holding the majority. That's not conspiracy. It's arithmetic. Governments will respond through redistribution, wealth taxes, digital oversight, universal stipends. Each solution adds layers. Each layer demands financing. More financing means deeper debt. The loop continues, but awareness changes everything. Once you understand the laws, you stop chasing distractions. You see stimulus as timing, not salvation. You measure policy by its flow, not its intention. You form habits that mirror the structure. Invest early, own scarce assets, minimize liabilities. That's the lesson buried in 300 years of finance. Prosperity follows comprehension, cause and effect. Gresham warned about quality. Cantillon, mapped sequence. Pareto exposed, concentration. Together they explain why some ascend while others remain still. Money is coded. Information. Power comes from reading it fluently. Most people master professions, not systems. They trade hours for currency without questioning its source, timing, or cost. Once you start asking, the pattern emerges. You stop reacting. You start positioning. The world is entering another monetary experiment. Rates climb, debt expands, trust trembles. And once again, the same old laws will decide the outcome. Those who learn them early adapt first. Those who ignore them will feel it late. You're not outside the system. You're already inside it. Every purchase, every loan, every investment feeds the mechanism. The question isn't whether you play, it's where you stand. So as you leave this video, think about proximity. Where are you in the flow? How do you move nearer to the source? Which assets will hold when quality drains from the system? These are the questions that divide spectators from strategists. Thank you for watching. If you learned something new, share where you're joining from and what time it is there. Your insight adds to the map. Stay aware. Stay educated. The laws of money never change. Only the players do.